Hey everyone, welcome to Fellowship of the Frugal. My name is Daniel. In today's video I'm going to answer the question, why did my mortgage payment suddenly change? You've been paying your mortgage every month, the same payment, all of a sudden one month you get it and the amount is different. Why is that? So I'm going to explain what happens and why that's happened in this video. And as always, if you enjoy what you hear, if you gain some value from it, I would love it if you would click subscribe and check out my other videos and keep coming back for more, and I'll be sure to keep the information coming out. So I hope to see you again soon, and I hope you enjoy this video. Thank you. When it comes to your mortgage payment, I see this all the time. People come into the building and say, hey, why did my mortgage payment go up? I was supposed to have a fixed rate. What's going on? I hear that question regularly, and it's come to my attention that a lot of people still don't understand how a mortgage payment is calculated and what all is included in that. So I'm going to address those in the next few minutes here. So to start with, whoever does your mortgage, the company that actually lets you borrow the money to do the mortgage, they're going to have their principal and interest payment that is due. So if you have a 30-year or 15-year mortgage, it is going to be a fixed rate mortgage. Now I know some mortgages can be variable, but for this video we're just going to assume you have a fixed rate. So you have a fixed rate mortgage, so that rate doesn't change, and your principal and interest payment does not change. That is fixed every month. That's if you have it for 10 years, 20 years, the whole course of the loan, that amount of the payment is not going to change. Where people get confused is on the other part of your mortgage payment, which is your escrow. So what is your escrow payment? That is your taxes and your homeowner's insurance. So both of those go into your escrow. So all your escrow payment really is a yearly estimate to pay your taxes and your homeowner's insurance. Now those amounts change every year, and so the estimates will change. And what the estimate is this year, if it's spot on, then the next year your payment won't be any different. But let's say there's an overestimation and then there's some money left over at the end of the year from escrow, then your amount will go down a little bit. But if there's an underestimate and the company had to reach a little further into their pockets to pay for your taxes and your insurance, then the difference is then passed on to you on the next cycle of 12 monthly payments. So how does that play out? So I have here a copy of a sample mortgage statement. Yours probably looks a lot like this. In box 3, you have your outstanding principal balance. You have a few other things, the interest rate, loan maturity date, those would be the ones that stand out here. On box 4, your explanation of payment due, you see the principal right there. Now the interest list, this example has 0, but more than likely your mortgage payment is going to have something listed there. And then in the next line down, you have escrow, and it says for taxes and or insurance. And that's an estimated payment. So all those combined make up your regular monthly payment. And then if you look at box 5, you can see the history for what you paid your past month, how much of your payment actually went towards principal, how much went towards interest, and how much went towards escrow. And then you can also see those categories paid year to date. Now on a 12-month rolling basis, your escrow is not going to change. Now it's going to be updated every year, and it is going to change at that point, but at least for 12 months it's not going to change in most cases. Your principal and interest will change. Every payment that you make, your principal is going to be a slightly higher number and your interest is going to be slightly less, because the closer you get to your loan maturity, the more you're actually paying towards your principal versus your interest. So in the front of the loan, your interest is going to be the much higher amount because the lender is going to get their income, which is the interest, up front, and then take a lower percentage over time as the loan is paid down. So this shows a breakdown of what that $1,043 payment is that you would be accustomed to paying every month on your mortgage. But that mortgage payment is consisted of 3 different parts. As I said, your principal and your interest, which that's a fixed amount that you pay towards it every month. Now, how much is applied does change slightly month over month, but how much you pay towards it does not change. But your escrow, as I said, that amount is what's going to be the difference maker when your mortgage payment suddenly changes. So why is that? Let's just go with an example just for simplicity's sake. Let's just say your annual homeowner's insurance is $1,200, so that'd be $100 a month. And let's say your taxes on your house are $1,200 a year. So the way that would break out is you take each one, and each one comes out to be $100 a month, so you would add those together, and then your escrow would basically be $200 per month. So $200 of your total payment would go towards that account. Now, it would build the account for several months, month after month, and then all of a sudden your property taxes are due. So what your mortgage company does is they reach into that pile of money or that escrow, they pull out what's needed to pay your property tax, and then they send off the payment and pay it. There may be some money left over in that account after that. And so you keep paying month, and then boom, all of a sudden your homeowner's insurance is due. So they reach into that pile, that escrow, they make that payment, and then that's paid. And then boom, keeps going, and then at the end of 12 months, the company essentially reevaluates how that went for the year. How close was the estimate? Was it spot on? I mean, if it was exact, which is probably never going to happen, but if it is exact, then for the next 12 months, your payment is not going to change. But if the estimate was low, let's say it was short by $600, that your homeowner's insurance was higher, and maybe your taxes were higher than what the estimate was, well then that $600 is going to be applied over a 12-month basis in your next year worth of payments. So that'd be another $50 a month that you would have to pay on your mortgage as opposed to what you paid the prior year. So that extra $50 is all because the estimate on the escrow was less than what the actual payments were due. So I say estimate. Now you may be asking, or you may be thinking, well, shouldn't they know what the payment's going to be? Well, it can change every year. If you've had a house in the last 24 months, I can almost guarantee you your homeowner's insurance has gone up. Some of them have doubled or more in the last 24 months. And your property taxes have more than likely also gone up. And so if during the course of that 12-month cycle for your escrow, if you get a bill from your insurance company saying, hey, now we're going to charge you $2,400 for your insurance this year instead of $1,200, then part of the way through your 12-month cycle, the payment increases, but yet what you put towards it is no different. And so there's a shortfall. Let's say the taxes are paid, and then the next year you get a bill that has gone up 50%, and so now it's $1,800 instead of the $1,200. Well, if the company reaches in to pay it and there's not enough in there to pay it and there's a negative balance that's due, then they're going to make up the difference by billing you for it in the next 12 months. Now, this has been very common in the last, like I said, 24 months, because homeowners insurance across the board have gone up, and then property taxes have gone up. So a lot of people have been low on their estimates, causing their mortgage payment to go up. But as I said, it's a 12-month cycle, and then at the end of the 12 months, the company looks to see how we did on our estimate. If it's low, then you take up more responsibility, or if it was a high estimate, then there's less put on you. So it could go either way, but more than likely, in recent days, there's going to be a low estimate on that, so you would have owed more. Now you do have the option, because you'll get a letter, and if you paid attention, you'll see you'll get a letter that says all this, and it may say something like, hey, there's a shortfall, we're either going to add $50 a month to your mortgage payment, or you can just write us a check for $600, and then that covers the difference, and then your mortgage payment will stay the same. Everybody's happy. So you have the option of doing it either way, but chances are, if you didn't see that statement, and then you didn't send a payment in, then 1 month, all of a sudden, that extra shortfall gets applied to your payment goes up, and then you're over here wondering what happened. That's when you show up to a branch like mine and say, why did my mortgage payment go up? Well, that's exactly why. So again, just to summarize what I've talked about, your mortgage payment is made up of your principal and your interest. What you put towards that does not change, ever, for the course of the loan. But, unless you refinance or something like that. But assuming you don't, it never changes. But then your escrow does change every 12 months. It's based on an estimate. The taxes and the insurance will change at some point. They may not change from 1 year to the next, but over the course of your loan, they're going to change, as we've especially seen lately. So that's why your mortgage payment changes. That's why your mortgage payment went up. So yes, your rate is fixed. That's not the issue here. The issue is how much of it is going towards those taxes and the insurance via the escrow account. So escrows are an estimate. They're just the best guess on what's going to be owed. The guess is always off by a little bit, and then they just make up the difference. But you can, when you see that escrow letter at the end of the 12 months, you can just write a check for the difference every year, and your mortgage payment won't ever change through the whole course of the loan. So that's one way to do it, but you may have more due at one time than you would count on paying, and it would be a lot to pay at one time, because insurances have more than doubled from what I've seen. And if you write a $1,200 check for a shortfall, that's a lot at one time. That's probably an additional mortgage payment depending on what your situation is. But a lot of that has really happened faster than normal in the last couple of years, and that's why. It's always happened, but whenever there's a big year with impacts on rates and cost of things like what has happened in the last few years, then it impacts it faster and larger than what normally happens. So with all that being said, I hope this helps clarify why your mortgage payment changed. It's all about the escrow. Taxes and insurance change, your mortgage payment is going to change if you don't write that check to make up the difference. All that being said, hope you check out my other videos. I hope this makes sense. I hope you do click subscribe. That means a lot if you do. And I hope to see you around on my other videos. Thanks so much.